Have you ever looked at the stock market and just thought, what is going on here? I mean, one day it's rocketing up, the next it's in a free fall. It feels like pure chaos. Well, today we are going to pull back the curtain on all that unpredictability. We're going to get to the bottom of what really drives the wild ride we call market volatility.
Okay, so let's just dive right in. We all see the headlines, right? The frantic red and green arrows flashing across the screen. It can feel totally random, almost like you're trying to predict the weather. But here's the thing. Underneath all that noise, there are some really powerful forces and, believe it or not, some clear mechanics at play. And this is really the million-dollar question we're tackling today. This isn't just about numbers on a screen. It's about trying to understand a massive, incredibly complex system. And I promise, by the end of this, you're going to have a much clearer picture of the engine that's driving all these price swings.
So all that chaos actually has a name. It's called volatility. You can think of it like this. A low volatility market is kind of like a calm, sunny day at the beach. But a high volatility market, whoa, that's a full-blown hurricane. It's the sheer speed and the size of these price changes that can feel so jarring. So what in the world causes this financial storm?
Well, the first part of the answer might actually surprise you with how simple it is. It's not just about complex economic formulas or algorithms. No, at its very core, the market is driven by us. It's driven by human emotions, the collective hopes and fears of millions and millions of people. And this right here perfectly captures the two great emotional cycles of the market. On one side, you've got the bull market. This thing is fueled by pure optimism and, let's be real, a healthy dose of greed. As prices go up, more people get excited and jump in, which, you guessed it, pushes prices even higher. It's a classic positive feedback loop. Then you have the flip side, the bear market, driven by pessimism and raw fear, creating a rush for the exits that just feeds on itself.
I love this quote because it just perfectly illustrates that collective mindset, right? A bull market feels like this amazing party that you just have to get into, and the more people that join, the better the party gets. But a bear market? That's when the music suddenly stops, the lights come on, and everyone realizes they need to get out now. And it turns into a stampede for the door.
So we get it. Emotions are the fuel. But how do these big, powerful feelings of greed and fear actually translate into the price of a stock, literally changing from one second to the next? That is where the actual mechanics of the market come into play.
You have to picture the market as this vast, sprawling ecosystem. On one side, you've got retail investors. That's folks like you and me. And on the other, you have these giant institutional investors, the big funds managing billions of dollars. All of them, all at once, are placing buy and sell orders, creating this constant, massive, real-time tug-of-war over what the price should be.
And all of this frantic activity is tracked in this really fascinating thing called the order book. Just think of it like a live, constantly updating map that shows every single buy order and every single sell order just waiting to be filled. It's like looking directly at the market's transparent, beating heart. And here's what that battleground looks like. It's really just a simple two-sided list. On the left, in green, you have what are called the bids. These are all the buyers and the absolute maximum prices they're willing to pay. And on the right, in red, you have the asks. Those are all the sellers and the minimum prices they're willing to accept.
So this map is showing us, in real time, the battle between supply and demand. The actual price of the stock at any given millisecond is determined by that tiny little gap between the highest bid and the lowest ask. And that depth you see, those big walls of buy or sell orders, that shows us where the price might really struggle to push through.
Okay, so if human emotion is the fuel and the order book is the engine, then technology is the turbocharger. In our modern world, there's this incredibly powerful, non-human force that has amplified the speed and complexity of the market to a degree that is just staggering.
First up, you've got high-frequency trading, or HFT. Now, this has nothing to do with long-term investing. This is about one thing and one thing only: pure, unadulterated speed. These firms use super powerful computers and algorithms to make thousands of trades a second, many lasting just microseconds, to profit from tiny, fleeting differences in price.
This analogy is just spot on. A long-term investor might be like an eagle, soaring high above, looking at the big picture. HFT is a hummingbird. It's darting around with unimaginable speed, making thousands and thousands of tiny little moves every minute just to gain that microscopic edge.
And if HFT is the raw speed, then AI is the emerging brain behind the operation. AI systems can do way more than just follow simple instructions. They can scan news articles, social media feeds, economic reports, all of it in real time, to find patterns and try to predict future movements on a scale that no human could ever hope to match. And look, this technology is truly a double-edged sword. On the one hand, yeah, it adds a ton of liquidity to the market, and it's helped lower transaction costs for everybody. That's a good thing. But it can also amplify volatility like crazy, sometimes leading to those sudden, terrifying flash crashes. And it kind of creates a two-tiered market, where the players with the fastest tech will always have an advantage.
Okay, so with all this swirling human emotion, these complex mechanics, and this blisteringly fast technology, how on earth do we make any sense of it? I mean, how can we possibly get a read on the market's overall feeling? Well, it turns out we have some pretty clever tools for just that. First, to get a sense of the general direction of things, we use benchmarks. And the big one, the one you always hear about, is the S&P 500. By tracking 500 of the biggest companies in the US, it basically acts as a high-level snapshot, like taking the market's temperature, to check the health of the whole system. But to measure the mood, the actual emotional temperature of the market, we use something else, something called the VIX. The VIX is cool because it doesn't measure price, it measures the market's expectation of future volatility. It is essentially a direct measurement of how worried investors are. And there is a key number you want to watch for here. When the VIX reading climbs up above 30, that's a signal. It suggests a very high level of fear, of uncertainty, and of just general anxiety among investors about what's coming next. And that is exactly why it's earned this famous nickname. When markets are tanking and you can just feel the panic in the air, the VIX tends to spike way up, making it the world's most recognized, quantifiable measure of pure market fear.
All right, so let's tie all of these threads together, shall we? We've got human emotion, we've got the mechanics of supply and demand, and we've got technology amplifying the whole thing. So what's the big takeaway? What does this all mean?
This, right here, is probably the most important thing to understand. Volatility is not a bug in the system, it's a fundamental feature. It's the natural, totally expected result of all these powerful forces colliding. It is, quite literally, the price of admission that you have to pay for the chance to earn the incredible long-term returns that the stock market has historically always delivered.
And that leaves us with one final question, and this one's for you to really think about. If we accept that these wild swings are a normal, unavoidable part of the process, then the real question isn't whether you can avoid them, you can't, but whether your investment strategy, and more importantly, your own mindset, are truly prepared to pay that price and endure the ride for the long haul.